Hello, and thank you for joining our webinar today, sponsored by the Access Forum. My name is Anastasia Papas, and I'm the founder of the Access Forum. It's a great pleasure for me to welcome Mariassunta Giannetti today, who will present her paper with Martina Jassova, Maria Lugnotti, and Caterina Mendicino. The paper is called Glossy Green Banks, the disconnect between environmental disclosure and lending activities. Mariassunta is the Katarina Martinsson Professor of Finance at the Stockholm School of Economics. Her research interests are in corporate finance and financial intermediation. She has published highly cited research in leading journals in finance, economics, and management, and has been honored with a number of prestigious international awards, including the Journal of Financial Intermediation Best Paper Award, the ECB Lamfalussy Research Fellowship, and the ECB Duesenberg Fellowship. Mariassunta has served as an associate editor of several journals, including the Journal of Finance, the Journal of Financial Economics, the Review of Financial Studies, and many more. She's also on the advisory board of the Academic Female Finance Committee and the American Finance Association, and is also a frequent visitor and advisor to central banks around the world. So as always, before I pass the floor to Mariassunta, I would like to invite you to take our short survey. So, here it is. So it's two questions. So the first one is, do banks with extensive environmental disclosures lend more to brown firms, lend only to brown firms with transition plans to greener technology, lend more to green firms? And the second question is, do banks with high environmental disclosures issue more green bonds or impose a shorter loan maturity to brown companies? So let's wait until people get the chance to respond. Okay, that's interesting. The first question, banks with extensive environmental disclosures, 41% said lends more to green firms. And to the second question, do banks with high environmental disclosure, 56% answered that these banks impose a shorter loan maturity to brown companies. I think, Mariassunta, your job is cut out now to explain to us why maybe that's not the case. But before I pass you the floor, I have an announcement to make. This Friday, which is September 15th, is the deadline for our 2023 E-Access Forum Research Prize, which aims to recognize outstanding research conducted by young scholars in macroeconomic policies and sustainability. This year's theme is financing the green transition. So if you're interested, or if you know somebody else who might be interested, you can find more information about the prize and how to apply on the chat. And it's basically on our website page. So, Mariassunta, the floor is yours.
Okay, thank you. You should unshare for allowing me to share. Thank you. Yeah. And now, so thanks a lot for having me. And let's talk about banks' environmental disclosure and how we study them. Before I start, I have to tell that since one of my co-authors is at the European Central Bank, and more importantly, since we use credit registry data from the European Central Bank, I want to stress that the paper and our findings are the opinion of us authors, and for sure do not reflect the opinion of the European Central Bank and the Euro system. So what does the paper do? Well, reading the press, you may have realized that on both sides of the Atlantic, there has been a lot of interest in environmental disclosures. So the SEC has discussed the possibility of regulating what listed companies have to report in their sustainability disclosures. And the ECB has been discussing doing something very similar for banks. What is the concern? Well, the concern is that firms like banks might disclose some achievement in some part of their business, while at the same time hiding and not discussing at all other other problems that they have in other, perhaps more important parts of their business. So misleading investors, depositors, customers, and so on. So since banks in the European Union in particular and have been increasingly emphasizing their environmental activity in investor reports and other voluntary disclosure, we thought to systematically analyze these documents. Now, we know that the disclosures bring banks and more in general companies many benefits. Companies with extensive disclosure are associated with higher ESG ratings, more loyal customers, and in general, lower cost of capital. As from the way you answered Anastasia's questions, it also suggests that reading environmental disclosure affects your prior about the greenness of the business of a bank. We have to know whether this is true, and this is what we explore in this paper. Basically, we ask whether the environmental sustainability disclosure of banks are credible, or if rather banks are just strategically disclosing in information on some minor part of the businesses that might make them look relatively good without putting any emphasis on the major part of their business that for commercial bank is lending. So how do we go to answer this question? So again, our research question is very, very simple. We want to know what is the relationship within what the banks disclose about the environment and the bank's lending activity. So to answer this question, we collect from bank's website a panel of reports of Euro area banks, and that we will analyze in order to gather information on these banks' environmental disclosures. Then we will relate how extensive the environmental disclosures are to bank lending to firms. And from the ECB data, we have access to all portfolio of the banks. So we do not observe only loans to the largest companies that typically people have explored using the syndicated loan market. We observe also loans to tiny firms. And in this context, we can explore whether banks that have a more extensive environmental disclosure lend relatively more to borrowers in brown and green industries, how much they lend to borrowers with a different level of emission. And here I have to stress that when we consider borrower level emission, unfortunately, we can consider only the largest borrowers, because for smaller firms, neither I nor the bank have any information about the emission. But we wanted to have a borrower level information on the greenness and brownness of the business, also for a relatively smaller borrower, in order to be able to zoom in within the industry. So what do? Well, we look at the business description of some 500,000 companies across the euro area, for which we can obtain a business description. And then we do textual analysis of their business descriptions using the EU taxonomy of green activities and technology. And we ask whether relatively more brown borrowers are getting more credit from banks that have more extensive environmental disclosure. So this is what we try to do. Let me give you an overview of our finding, and then I will be more detailed about what we actually find. So we start from the analysis of the European Bank's environmental disclosure. We make textual analysis of banks' sustainability reports, and more in general of bank investor reports. And we find that, well, the extent at which a bank discloses its environmental sustainability policy is closely related to the culture in the country of incorporation of the bank. So, for instance, to the extent of social activism. And it also reflects the bank ESG rating. So these suggests that the banks with more environmental disclosures have a reputation for being more sustainable that is consistent with your prior. And also they disclose more because that reflects the culture of the countries where their headquarters is. We also find that these banks tend to be more involved in green bond issuance, which is a very observable activity. We know from the Financial Times, the Wall Street journals, when companies issue new green bonds. So this evidence tells us more or less what are the characteristics of the banks that are disclosing more. And it also tells us that our textual analysis is capturing something that is concrete. It's capturing a bank reputation, is capturing bank involvement in green-related bank activity. And an interesting fact is also that the banks that disclose more about their sustainability policies are banks that in the past have been lending relatively more to borrowers that we classify in brown industries. But this is not what we are going to consider. We are going to consider the bank's policy lending forward, to whom they give new credit. And we find that, unfortunately, when banks decide to give new loans, the banks that stress more their environmental sustainability policy in their disclosure tend to lend more to borrowers that have high emission. And this is regardless of the specific measure that we use. We can measure brown borrowers at the industry level, or we can try to zoom in within the industry for allowing for heterogeneity. These results appear very robust. So why is this so? One might think that perhaps these banks are still funding green investment, for instance, by funding the transition of borrowers in brown industries to greener technology. But we don't find any evidence of this. If anything, the borrowers in brown industries that are receiving relatively more credit are borrowers that do less research and development, that invest less. And in general, we know from our other studies that the borrowers in brown industries that try to introduce more new technology tend to be young. And there is no evidence that the banks with extensive environmental disclosures fund relatively more young borrowers in brown industries. So who are the brown borrowers that these banks are funding? The brown borrowers that these banks are funding are borrowers with which they have a close relationship. They have extended a large proportion of loans to these borrowers in the past. And they tend to be the weakest borrowers in brown industries. And we also find that especially the banks that are a bit weaker because they have low capital adequacy tend to extend loans to weak borrowers in brown industries when they have extensive environmental disclosures. So what is our conclusion? Well, our conclusion is that these environmental disclosures do not appear to reflect the truth, and that banks overemphasize their climate goals while continuing the relationship with borrowers with high emission. So this would be evidence of greenwashing. Before going on, I want to emphasize our concept of greenwashing here. We think of greenwashing as a strategic disclosure. Perhaps a bank has been contributing to being involved in the issuance of green bonds, but the green bonds really raise very little capital with respect to the overall bank lending. And these banks just forget to discuss their lending to borrowers in brown industries in their disclosures. Another way to think of the concept of greenwashing that we are going to use is that perhaps indeed these banks kept lending to one specific industry or to one specific large brown borrowers. But overall, once you zoom in and you look at the aggregate portfolio, there is no evidence that this bank lending is becoming relatively greener. So this is what we are going to discuss. And if there are no questions, I would start talking about the data. And please, Anastasia, let me know if there are any issues that you want to bring up. That's okay.
We can
yes.
At the end.
Yes, please. Do you want to ask? Okay.
Something that we can address at the end.
Okay. So what are the data? Well, we use the loan level credit registry of the euro area, AnaCredit. And we have basically all loans of the banks in our sample, that is all loans that are above 25,000 euro. We focus on euro area systemically large banks. And the reason is that when we analyze the investor reports, we want to have banks that have investor reports in English. We will be able to look at loan size, interest rate, maturity, And we will focus on newly issued loans that started from 2014 to 2020. So what are our measure of green and brown loans? We start from the industry level. That is, we look at the greenhouse, we obtain a greenhouse emission data at the industry level, a country level by year. And we standardize by the industry value added. But we have also firm level emission for large borrowers. And as I will discuss later, we do also textual analysis of business reports. And then we have other standards of financial data that you see listed here. So let's go to the environmental disclosure. We processed all these documents, and basically we measure how extensive the environmental disclosures are, counting the words that are related to banks' energy use, emissions, biodiversities, and other activities that are commonly considered to affect pollution: car, building certificate, pollute, waste. So when I say that a bank is a high environmental reporter, I base this statement on the ratio of environmentally related keyword to the total number of words in the bank reports. So what do you see here? Well, what I was anticipating before is that the banks that have a more extensive environmental disclosure had past problems, meaning that are banks that in the aggregate in the past have lent more to brown industries. So they have more brown exposure. But what we ask in the paper is to whom the new credit is going. So is our main regression, therefore, we look at the amount of loans that a given firm during a given year gets from a particular bank. And our inference is based on this interaction term. That is, we ask whether a borrower that we classify as brown gets more or less credit from a bank that we define as high environmental reporters. So if banks in their disclosures are not only trying to portray a more green profile, but they are also walking the walk, we would expect that the estimate on the coefficient of the interaction variable of interest is negative and significant. What do we observe? Well, we observe that if anything, banks are issuing more and larger new loans to borrowers in brown industries when they have more extensive environmental disclosures. Could this just reflect the demand for credit that a bank faces? Banks are on different countries, countries are specialized in different industries, and we could just be picking that. Well, no, because our methodology attempts to controls for demand in two different ways. First of all, in column 4 and 5, we use what is often considered the gold standard. We look at the loans that two different banks with different level of environmental disclosures are extending to precisely the same borrower. And we observe that, well, banks with more extensive environmental disclosures are extending more new credit to this borrower. But we have also another way to control for demand, What you observe here in column 2 and especially 3, where we control also for bank shocks with the interaction of bank and time fixed effect, is that the banks seem to extend more new credits to borrowers in brown industries, also when we control for demands by including interaction of industry, country, and time fixed effects. So this is not compensated by relatively more lending by these banks with extensive environmental disclosures to borrowers in green industry. So these banks are not engaging in more green lending, at least when we define credit extended to borrowers in industries that are not polluting. Results are very similar when we look at borrower level emissions, okay? So we use Urgentem to measure the scope 1 and scope 2 emission of particular companies, and controlling for demand for industry, country, and time fixed effect. We continue to observe that these borrowers in these industry and countries obtain relatively more credit from banks with extensive environmental disclosure. When we include the interaction of firm and time fixed effect, of course, we have less power in the data. We find an insignificant effect, but I want to stress that these continue to tell that the banks with more extensive environmental disclosures are not walking the walk, because they are not decreasing the extent of their exposure to brown industries. So these results are very robust. So going back to one of the questions of Anastasia, for instance, we don't find any evidence that the banks with extensive environmental disclosure that lend to borrowers in brown industries are decreasing the maturity of their loans. This would be evidence that these banks try to exercise control or to push the borrower to change. But the loans to these borrowers seem to have exactly the same maturity as loans to our other borrowers. Similarly, if we look at the interest rate on new loans, there is no evidence that the banks with more extensive environmental disclosures try to make these borrowers pay more for the credit they receive. So both from the quantity of credit and the contractual characteristics, we don't find any evidence that high environmental disclosure from the bank are related to more restrictive credit conditions. We find, however, that when we think of new relationship, then banks seem to be doing what they say, meaning that when banks lend to new borrowers, they are less likely to establish a relationship with borrowers in brown industries. Problem is that they do not terminate the relationship with the brown borrowers. And actually, they are less likely to terminate a relationship with the brown borrowers that presumably have a harder time to access alternative source of funding. So at the end, what we observe is that the exposure of banks with more extensive environmental disclosures to brown industries increase over time. So, and you might have at this point many questions about what we are capturing with our textual analysis. So for instance, a question I often get is that, but perhaps these banks are just informing investors of the gloom of their portfolio. this is unlikely, because the banks wouldn't do that in their investor report, especially because there is no regulation that compels them to do so. But nevertheless, we perform a textual analysis to evaluate this possibility. And specifically, we construct a measure of environmental disclosure that considers the sentiment with which those words that are in our dictionary and are related to the environment are expressed. So it turns out that banks with more extensive environmental disclosure tend to disclose about the environment with a very positive sentiment. And indeed, if we use a proxy for high environmental reporters, based on the sentiment of the disclosure, we find exactly the same results. We also show that our results are basically unchanged if we exclude any words related to the environment that are associated with climate risk. That is, words that could reflect concerns about the future losses and so on. So these results are robust, okay, and do suggest that banks that are more trying to establish a reputation for being environmentally sustainable are actually lending more to borrowers in brown industries. In the rest of the paper, we try to highlight the channels. Why would they do so? So the first interpretation, that is more benign to the banks, would be that, look, if banks and any investors want to fund the transition to a green economy, they cannot fund the service companies that would emit very little anyhow. They have to help the companies in brown industries to move to greener technology. So perhaps what we are observing here is simply that banks with high environmental disclosure are providing the capital for borrowers in brown industry to move to more green technology. So we try to test. One way in which one could try to do it is to focus on the few borrowers for which we observe emission, and to look at whether in the years following the receipt of a loan, these borrowers decrease their emission. We look at the following 3 years and we don't find anything. But we don't think this is a good test. The reason is that 3 years may just be too low. So what do? Well, we try to do the investigators, and we look at what kind of borrowers in brown industries are receiving relatively more credit. We know that the transition from brown to green technology requires a lot of investment in fixed assets and also innovation such as R&D. So we ask whether the borrowers in brown industries that are receiving relatively more credit from banks that emphasize the environment are firms that invest relatively more than the other firms in their own industries, or that do relatively more research and development. We don't find any evidence on this. If anything, these firms may invest less than other firms. We also don't find that new entrants in brown industries, that is a young firm in brown industries, that would have a stronger incentive to disrupt the old technologies, are getting more credit from high environmental reporters. Similarly, we don't find that the companies in brown industries that get credit from these high environmental reporting banks have signed a commitment to decrease their emission, such as the Science-Based Target Initiative. And we redefine brown and green borrowers using the textual analysis of their business description. And what do we observe? Well, no evidence that green firms receive relatively more credit. So it doesn't look like that these banks that stress the environment in their disclosures to investors are funding green technology. So, and these are the actual tests that I was discussing. So why do they lend to these firms? So the next step is why these banks continue to lend to brown borrowers. One reason is that, well, these we know that the relationship with the borrower is an important feature of the business of a bank. A bank cannot just suddenly cut credit to improve its sustainability, because the borrower would suffer, and actually this would be a feedback on the bank balance sheet causing distress. So what you observe here, well, is that the banks that in the past have extended a higher fraction of credit to a given borrowers are more likely to extend relatively more loans, even if this borrower is in a brown industry. And the fact that the effect is not significant when we use firm time fixed effect here depends on the fact that a lot of these borrowers have only one bank, and that's precisely when the bank is basically locked in and continues to lend. And actually, the brown borrowers that are getting credit from these banks with extensive environmental disclosures are borrowers that are a bit worse than the other borrowers in their industries. They have an ROA that is lower than the median borrowers. They have a low sales to employee, and they have a lower interest coverage ratio. So these are borrowers that are relatively less financially healthy. Perhaps they are not a zombie, but these resemble a lot zombie lending. That is, the bank is locked in the relationship with these borrowers, and even if they are brown, the bank wants to avoid to cause distress, because in that case, it would have to discuss the financial losses as well as the exposure to these brown industries. So overall, using this zombie term in a bit more broader way, what we say is that relationship with financially unhealthy firms seem to explain why the environmental disclosure of the banks do not reflect their actual lending portfolio. Is perhaps banks try to improve in the relatively new enterprise. They get into the issuance of green bonds, and when they select new clients, they are reluctant to establish a relationship with brown borrowers. But the larger part of the balance sheet of a bank is existing relationship. And what we observe here is that existing relationship continue to affect the future lending of the bank. So we show a bit more evidence on the characteristics of the banks that report a lot about the environment and continue to lend to borrowers in brown industries. And what you observe is that, well, the banks tend to have tend to be relatively less healthy. They have a lower tier 1 capital. These are precisely the banks that don't want to realize the losses, okay, because of the regulation. The banks also tend to be large, meaning that these large banks are much more visible, and probably they have pressures from institutional investors to build a reputation for being environmentally sustainable. The issue is that a lot of this is strategic disclosure. We don't observe that current regulation like audited sustainability and so on make reduce this current of behavior that we highlight. And you might be, so our sample here starts in 2014 and arrives to 2020. And you might be wondering whether this effect decreases during our sample period. And the answer is, well, unfortunately not. The environmental disclosures by these banks have been increasing a lot. And our results that I've shown you so far are mostly driven by the post-Paris Agreement part of the sample. The effect on this interaction term becomes larger and more statistically significant starting in 2018. So what did I show you? Well, banks stress the environment in their disclosure, but nevertheless, their new loans seem to go to borrowers with high emission. And this is regardless of the proxy that I've been using. There is unfortunately no evidence that the bank's loans are trying to favor these borrowers in brown industry transition to greener technology. We rather observe that the close bank relationship, and especially with the financially unhealthy borrowers, are the driving factor that limits the reliability of banks' environmental disclosures. So regulating the contents of bank disclosure, that is forcing banks and other listed companies to have a more holistic approach when they disclose, requiring what they exactly have to disclose, seem to be crucial to make environmental disclosure informative. So far, the concerns of the Security Exchange Commission in the US, the European Central Bank, and the European Commission in the EU are fully supported by our empirical evidence. So this is what I wanted to share with you today, and I look forward to hear your questions.
Interesting presentation, and I'm sure that audience did not expect the results that you presented. You touched upon what needs to be done, what supervisors do, and this is a question that has been put on Q&A, which is, can EU banking institutions be more intelligently regulated, informed, nudged, or otherwise coerced or conditioned to do what measurably leads to evidently greener outcomes? I have to say that this issue is not just a European banking problem. There was another Federal Reserve Board analysis, did not as thorough as yours, not as not sort of focusing so much on the disclosures, but they looked at all the systemically important banks globally, and they found the exact same results as you do. So this is really not just an issue for European banks. So I don't know if you want to elaborate a bit more on what led you.
So the fact that disclosure to investors are not informative is not only an issue in Europe. It is an issue that affects banks and affects other firms. Actually, looking at banks is an opportunity because, you know, when we look at other industrial companies, it becomes very hard to figure out in what kind of technology they are investing, what kind of fixed assets they have. While for a bank, we know the main assets is really bank loans, so we can try to look at that. Said that, I was stressing a lot during my presentation. I use different kind of measures, not only industry level emission, but I'm also looking at business description and so on. And this reveals a challenge, meaning that, of course, the regulator should ask banks to disclose the scope 3 emission. That is, what is the value-weighted level of the emission of the borrowers of these banks. But that's not easy for the bank itself, because currently, we know scope 1 and scope 2 emissions are only for a tiny number of firms around the world. If you look at data set like Urgentem that we use, or TrueCost that I've used in other research or so on, those cover only the largest listed companies across the world. It's not even all the companies that are part of the MCI. So at the end, the bank has to come up with a way to estimate the emissions. And we are currently very far away from that, okay? So basically, the European Commission is taking some steps to enhance the disclosure of any company. And that is the first step that is necessary for better bank disclosure, because currently will be just another layer of speculation and bureaucracy.
Another question is a clarification question, and they ask, is there any differentiation between extensive and high disclosure?
No, it's just the words is high disclosure. That's yeah.
So third question, could you say something about distinctions between countries?
So we didn't do it yet, but of course we can do it very easily. What I can tell you is that when we look at where on average the bank that disclose more are, those are in the countries that exhibit more social activism, where people believe that sustainability issues are important, that the climate is important, and so on. But of course, we can distinguish between countries, look at South or Northern Europe and so on. But we didn't do it yet.
I think exactly to this point is the next question, which is, do the economic activities of the brown borrowers take place from which countries? Are they more from European emerging countries, or which is just, you know, you simply touched upon?
No. Is so of course the banks we have activities everywhere in the euro area. Okay, but the largest part of the borrowers that of these banks are generally local. Okay, so that's and so this is I would say that we can do a bit more look at a bit more cross-sectional evidence there, but from what I know about international banking is that most of the firms get credit from domestic banks, so most of these borrowers are local.
I have a question, might be I'm listening to your presentation and I'm thinking it's true that the loan portfolio of the banks is not a public information, it's rather a private information. But green firms, who are in need of loans to start, they read the disclosures and then they find that, loans are not so forthcoming. Has there been any sort of reaction from this type of borrowers where they feel that they're not being well served from these banks? Is there any way?
So I would say that what the results say is that green borrowers, if anything, may have easier time to establish a new relationship. So loans are equally forthcoming from banks that have extensive environmental disclosures and other banks. I didn't say and didn't want to imply that the green firms are financially constrained. I don't know that. Our study cannot answer this question. I want to add, however, that real green firms that are exploring new technologies are very risky because in 10 or 15 years, there will be some technologies that will prevail and will be the technology that is used by everyone, and a lot of others that have failed. And perhaps bank lending and debt is not the right instrument to fund green innovation and green technology. So I would say that if you want to get something out of this presentation, besides the fact that according to our analysis, the environmental disclosures seem to be a bit of advertising, but not very realistic. There is also the issue that the bank business model is based on close relationship with the borrowers. So when the European Commission or the ECB expect banks to guide the transition, perhaps they are misplacing their expectations. There should be different type of regulation or perhaps a different type of investors that guide this transition.
Thank you. One last question again. We have one more, I think, on the Q&A. What should regulators and governments do to manage the decline of these brown zombie companies? Is there a path we can take to convince banks to limit their credit?
Well, people have been discussing brown capital requirements, okay? And if I think just about the direct effect, of course, making it more expensive to lend to these brown borrowers might help, okay? But we have to remember that some banks have a lot of exposure to brown borrowers. So when we design these brown capital requirements, we have to make sure that we just don't increase the bank financial constraints. The bank then wouldn't want to make losses and may just cut lending to less polluting borrowers. So it is a very hard question, but perhaps if we are interested in making sure that there is less brown activity or that polluting technologies are phased out, we should regulate the borrowers, not the banks. That's.
I mean, to this, this was going to be my question, is that if we sort of find a way to nudge or coerce or what have you banks to curtail their lending to high CO2 emitters. I mean, there's always the risk that they will go into shadow banking to, I assume, to for their credit needs, and that creates another set of problems in terms of financial stability. Possible?
Yeah. So yes, possible, but to the extent at which past relationship matter, perhaps new entrants, shadow banks wouldn't lend as much. Okay, so that's what I would learn from my results. The past matters, and perhaps to have a clean start, we need to regulate the technology, the emission, and give incentive to the firm.
Perfect. I don't think we have any other questions. This was a very interesting, thought-provoking presentation, Mariassunta. Thank you very much. And thank you all for joining us today. Onwards and upwards, I guess, on this issue. More work needs to be done. Thank you very much. Bye-bye.
Thank you. Thank you, Anastasia.
Bye.
Thank you for having me. Bye.